this month is almost over. The program is Gilbert Talks Taxes. I am Gilbert Carmona. I am an enrolled agent. An enrolled agent is a person enrolled, licensed by the Internal Revenue Service, the Department of the Treasury, to represent taxpayers in all matters, whether it's doing a simple tax return or arguing a complicated point before the Internal Revenue Service. An enrolled agent can do it for you. By the way, there's only 47,000 enrolled agents in the country. Todd, my engineer this morning, Todd Kaiser, good morning, Todd. 47,000 enrolled agents. Enrolled agents are like CPAs and tax attorneys, except we can represent clients all around the world. We are licensed by the IRS. That makes our jurisdiction unlimited. I have clients all over the world, expatriates that live in other countries, that have to file tax returns here in the United States. Taxation is all I do, although I also do business consulting and financial planning. I give financial advice. I give all kinds of advice. Sometimes whether they ask for it or not, Todd, I still give it to them. The program is Gilbert Talks Taxes, WCAB 590 AM. Those of you live streaming, now Todd is having some technical difficulties
Just an audio.
with our live stream, but he's working on it. He's been feverishly working on it for the last 20 minutes. We think it's an internet problem. We're not sure, but he's taking care of it. But for those of you, it's just an audio problem. You can see us at www.wcab59.com. Northland Cable Channel 5 subscribers that are listening to us, good morning. We're back on.
Well,
He is. I'm telling you, you are, well, when you've got this much energy here on Gilbert Talks Taxes, you're going to have audio problems. I didn't blow anything out, did I?
No, you're good.
This is the most researched tax program on the radio in the United States. Todd, the most researched. Todd said I came in unprepared. What I said is I didn't know what I was going to talk about because I had so much to talk about. There is so much happening. I've just got to get on a focus here and get in that vein, because literally since we've had tax reform, it has just been incredible. We have this year, of course, that's the tax. Officially, the tax season begins Monday. Officially, January 29th. Of course, we've been working all month doing W-2s and 1099s for everybody. I've already filed 31 tax returns, and I have about another 18 ready to go, ready to get people in there to just sign and go over it. A lot of these are business people whose returns, they pretty much knew at the end of the year where they were at, their expenses, their income, and we had things wrapped up for them. Of course, those don't have to be filed till March 15th, but we've got them ready. Now, interesting, the IRS said it would not start accepting tax returns until January 29. I've put 31 through already, and I've actually had 12 that have been accepted, because I know that they'll run tests. Now, are you going to get your refund any faster? Probably not. Their refunds are on a timeline. This year, they are going to hold refunds that involve earned income tax credit and child tax credit. They're going to be holding those refunds until February 15th. They'll be releasing those after that date. The IRS says you should be receiving those by February 27th. Now, those are tax refunds that have child tax credit, earned income tax credit. This is a live program right here on WCAB. If you would like to ask a question, Todd will be more than happy to take your call and hand it to me. If I can answer it on the air, I will. The telephone number here to the studio is 287-3356. If you need to call me, my telephone number is 828-289-9300. I have an office here in Rutherfordton at 113 Whitesides Road. I also have an office in Tryon, Polk County, the beautiful Art Deco building at 226 South Trade Street, right off the historic downtown in Tryon. So I really don't know where to start. There is so much happening. Let me get a few things out of the way first. I want to thank the people that commented on the beginning of the program last week. I shared some scriptures that I had just been thinking about, and some things that had been bothering me about what's going on. with not just about taxes, but ultimately it is about taxes, because every economic decision, every economic event ultimately somehow is a tax event. I mean, taxation is how our government gets their money, and taxation is what they use to get what they want, meaning Congress. If Congress wants something, if they want you to buy whatever, they'll give you credits. I mean, remember cash for clunkers. The government was trying to bail out General Motors, which was they should have just let the whole thing sink. But anyway, they wanted to bail out General Motors, so they gave you cash for clunkers. They want you to buy green cars, electric cars. So there's a credit, a pretty generous credit, for buying, Todd said 4,500. Some of them are as high as 7,000, depending on the car. They're different cars, different credits. Now, they may have changed. I haven't had any this year, but I had I had several last year and several the year before. So they want you to do this. We want you to put a windmill in your backyard. We're going to give you $10,000 if you do that. So people say, well, hey, I could use the $10,000. Go ahead and do whatever. So taxation, it affects our lives and every economic decision. We are in, if anybody hasn't heard, you really need to consider your media sources. We are in the best economy of a generation. It's not even, I said it's the best economy since the 80s. I'm going to say it's the best economy since the 40s. And the only reason the 40s went into the 50s, gave us the economy we had then, was because of the war. We ramped up for a war economy, put everybody to work, created manufacturing as we know it today, and it was an incredible economic boom. Looking back at the mid-40s and the late 40s, the war years did more than every social program FDR created before the war. You remember some of the WRP programs. We actually were the recipients of a lot of those programs here in this county. There were the little lake over at Doggett Road was that program that did a lot of dams in the county, a lot of road projects were an effort to put people to work. The government subsidized a lot of programs. But the war was the saver. It ended the Great Depression, was the war. I'm going to say we're in the best economy we've ever been. The Dow has yet to hit another high. But what do you see on the media? Some executive of some company telling you that this thing is going to burst any day. You know, if you do that long enough, you're going to be right, because it's in cycles. The thing moves in cycles. You have 3 good years, 3 bad years, 3 neutral years. It usually just cycles. There's ups, there's downs. So if you do it long enough, you're going to be right. And you can say, see, I told you so. My argument is always, where were they in 2007, 2008, 2011, when the economy did crash? Nobody was telling you, this economy is going to crash. They were all telling you, things are good, you better invest. And people invested, and look what happened. We are in the best economy we've been in. This is what tax reform feels like, folks. It feels good. 2 weeks ago, we had a changing of the tax rates. So everybody by now should have gotten at least one paycheck. If you're paid every 2 weeks, you should have gotten one by now. And if you notice, there's more money, take-home money, on that paycheck. That's because of the tax reform that we have. I had somebody call me. They said, I'm doing payroll, and all my employees are getting more money. Am I using the right rates? I said, yes, you are. Keep going. For some people, it's been $30, $50, $60, $100. It just depends how much money you make and, you know, dependents and all that. So it's variable. It's not like a flat, everybody's getting another $30 a week or $50 a week. The average seems to be somewhere between 30 and 50. 30 and 60. That's what I've been hearing. Just the different people I talk to. Some of the higher net worth people have reported getting a little bit bigger. We'll know after a few payroll cycles, because then you've got your people that get commissions and your people on salaries that get paid once a month. When we start factoring all that out, we'll have a better take of what an average is. But everybody's getting more money. People are having more money to pay bills. They're having more money to spend. Again, that's what tax reform feels like. My software does a really interesting thing this year. After I do your tax return, and those 31 tax returns I've done, there's actually a calculation that if everything's the same, your income, your children, your investments, everything, your income, your expenses are the same, what your refund or tax bill, if you owe, will be next year because of the new tax reform, the Tax and Jobs Act, Tax Cuts and Job Act, is what they're calling this bill. And everybody, now I know it's early. Typically the people that come in right now are people that are getting refunds, so they run in to get their refunds for me to do their tax returns, get them shipped off right away. In February and March, we'll start seeing the people that owe. Those are the ones that come a little bit later. No hurry there, because they owe. But so we'll get a better picture of it. But I'm tracking this. So far, everybody whose tax return I've done, next year, assuming everything is the same, I got to say that, I can't say that enough, assuming everything is the same, next year, they're getting anywhere from $500, the lowest one was $567, the highest one was $1,876 more. So the refund they're getting this year, next year, it would be between $567 and $1,800 and almost $1,900 more next year. The only person that was a zero, there was no change, was an elderly couple I had who basically file a tax return. They get a little pension income and they withhold. So the only reason they even file a tax return is to get that little refund. Theirs is going to be flat because theirs is flat. They're below the threshold. They're just filing a tax return to claim a refund. Theirs was zero. So really that's an outlier in the thing, but I'll have a better feel for it after we get into this and I do a couple of hundred more, and it's going to be real interesting to chart this statistically. I mean, I'm an accountant. This is what I do. It's going to be really interesting to chart this and see what is happening. But everything we're seeing is fantastic. Really fantastic. And that's not a word I use lightly, Todd. It's like fabulous. I don't use that lightly. Only certain things are fabulous. And this one is one of them. I'm telling you. I mean, I can't be excited enough. And I'm saying that to encourage people, because you're hearing some news to the other side, and it's not. Now, last week, I finished talking about things that this tax bill eliminates. And I wasn't able to get into it at the level I want to, so let me get into that before the break. The tax reform bill eliminates tax benefits for business vehicle trade-ins. Okay, so what this is doing is, under the prior law, now we can still continue to use Section 1031. This is when you buy real property, how that real property is taxed or not taxed. Okay? And this is for you business owners. It's also for personal property, but it's for your business owners too. Your ability to use Section 1031, and you know who you are. If your accountant is not explaining this to you, please find another accountant, because this is very important if you're a business owner and you buy and sell a lot of equipment, or you just buy a lot of equipment because you need a lot of equipment. Most of my clients buy a lot of equipment and just wear it out, and they have to buy more. And there's the resale value of it's hardly anything, so they'll just keep it for parts. It just depends on what the business is. But your ability to use Section 1031 tax-deferred exchange, it's a tax-deferred exchange. You're deferring the tax, you're exchanging property, you're buying property, new property, getting rid of old property. So it's a strategy, Section 1031, to use your ability to use Section 1031 tax-deferred exchange on personal property, such as your business vehicle, an airplane, any equipment, or collectibles, if that's part of your business, is gone. Tax reform killed that. Okay? So your new ability to use Section 1031 tax-deferred exchange for personal property means that you no longer treat a business vehicle trade-in as a non-taxable event. Now that trade-in is a taxable event. So, but having a taxable event does not necessarily mean that you're going to pay more taxes. It just means we're going to need to apply a new strategy here. Okay, so there's more than one silver lining to this problem. Okay, if you pay self-employment taxes, you know who you are, Schedule C filers, You pay self-employment tax. Some K-1 filers, too, will pay self-employment tax. You usually come out ahead if you use the buy and sell strategy rather than a trade-in strategy. Okay? With the buy and sell strategy, you're saving on self-employment taxes because you don't pay self-employment taxes on the sale of the existing vehicle, and you deduct depreciation and or Section 179 depreciation. That's still there, and that is fantastic. It's a very powerful tool, Section 179 depreciation, expensing on your new vehicle. Even if you're using the IRS mileage rates, they give you so much per mile. It's an all-encompassing number. It includes depreciation, which is your wear and tear, gas, insurance for business use of your vehicle. You still benefit. I've got some examples I can get into. Todd, where does the time go? It's already time for a break. Good thing I was unprepared this morning. Okay? If you're using Section 1031, please, I've got 3 pages of notes on this. I can get into all kinds of examples. I don't want to lose the people. Some of them are very complicated, and I can discuss this with you. If you have this kind of depreciation, or if you have a business and you want to know how this is going to affect you, you need to talk to me. My telephone number is 828-289-9300. If your accountant's not talking to you about this stuff, please find somebody that is. This is major. Let's go ahead and take a break, and I'm going to get back and talk more about business use of your vehicles. I had a question this week about business vehicles that the company lets employees use. What are the IRS guidelines on that? This is Gilbert Talks Taxes right here, WCAB 590 AM. I want to tell you about a little-known Rutherford County gem, Integrity Marble and Granite, located at 287 Shiloh Road in Forest City. They are the premier stone fabrication company in the western North Carolina region. They specialize in granite, marble, and natural stone, offering complete design and installation. Their design center and Kohler showroom features vanities, decorative accessories, bathroom, and kitchen fixtures. You do not have to go to Charlotte or Asheville for this kind of quality. We have it right here in Forest City. Stop in their showroom and browse their beautiful displays, or you can call 828-247-8801 for a free quote. You can also go to their website, www.integritymarblegranite.com, and look at the pictures and see samples of their available materials. Now, mention you heard it on Gilbert Talks Taxes, and they will give you $100 off any sink purchase. That's Integrity Marble and Granite.
My closet keeps shrinking my clothes. And if you have that problem, take them to Nancy at Nancy's Alteration Shop at 610 South Broadway, Forest City. Call Nancy today at 429-6900. Wear the clothes you like to wear. Let Nancy bring them back to life for you. That's Nancy's Alteration Shop, 610 South Broadway, Forest City.
We are back. This is Gilbert Talks Taxes, WCAB 590 AM. I am Gilbert Carmona. I'm an enrolled agent, and I am here to talk about taxes. You can tell I'm really excited about what's going on here. This is my time of the year, and there is a lot going on. Now, in the break there, real quick, Todd said to me, and who do we thank for this great economy that we're having and all this extra money? I mean, the Democrats came out and said that
crumbs.
Well, Pelosi said these are crumbs. These are crumbs. And I said it last week. I said, I don't know about you, but $40 a week, $50 a week more for me is, I mean, that's $2,000 a year. I don't know. That to me is not crumbs.
Vacation.
That's a nice vacation with the family. Yes. More than that, I mean, it's an enhancement to your lifestyle. Let's say you're making $25,000 a year. That's almost 10%. Let's look at it that way. That's 10%, 8%, 9%. Compared to what the Democrats have given us, let's really compare it with the crumbs. You remember the Obama? Well, I can't remember what they called it, but there was a deduction in one thing and an increase in another. So your paycheck went up by $20, but then you owed $35 on the other end. It was a net loss. But that was supposed to be economic reform. It was, I knew a man that I really respected who knew a lot about. He called it monkey math. It's all monkey math. It's monkeys doing the math. That's what this is. He was a PhD, and that's what he called it. I didn't make that up. I don't want to take credit for that. He called it that, and it really is. And Maxine Waters said that African Americans right now, the black community, is having historic, record low unemployment. I said it here 3 weeks ago. Record low unemployment among the African Americans, and it's not just that they're all working more. The jobs they have are higher skill set jobs that pay better. So the entire African American community is enjoying a better economic situation. Maxine Waters said that Donald Trump shouldn't get the credit for that. Actually, I don't know that well, she doesn't think he should get the credit for anything. She wants to impeach him. The best economy in a generation, and she wants to impeach him. Because they're not getting the credit for it. And let me tell you something, they never will. Increasing taxes never works. Everybody that's ever studied economics can see that. You just have to do the math. It never works. So this is what real tax reform feels like. And folks, it's just beginning. I mean, I'm going on record saying it today. This is just the beginning. They're the CEO of Goldman Sachs, I think. I don't even know who. Somebody who, for whatever reason, feels he's got authority to speak on this, said a crash is just around the corner. I'm going to say, no, it's not. This is a correction in the right direction. Corrections become such a bad word. Oh, we're due for a correction. That means the economy's going to crash. No, this is a correction, but it's just going the other way. How long is it going to go for? I don't know. Nobody knows. But to say it's right around the corner and it's going to just explode tomorrow. Remember all the people after Donald Trump was elected that said to pull your money out of the stock market? If you listened to them, number one, if you had your money in stocks right now, the stock market is up 44%. So if you had your money in raw stocks in the stock market, your stocks are 44% up. If you invested in a conservative mutual fund, a highly diversified S&P 500 indexed mutual fund, you're up anywhere from, every fund's different. Every one of them is up. I have seen 10%, 15%, 20%. I saw yesterday 18.3%. My own is up. It's get me going. I'll spend another 15 minutes here. Let me get back to I got a question about a business owner. What does the IRS feel about, what are the IRS's rules about employees driving business vehicles? Okay, let me tell you what the IRS thinks about that. If you're an employer and you part of the job is you're going to give that employee a vehicle, any vehicle, unless it's like a heavy duty vehicle that they will only use for work, and you're going to let the guy drive it home and then drive it back to the job because it's just easier than having him go somewhere, pick this piece of equipment up and drive it to the job. Sometimes for whatever reason, the guy could live close to the job. It's more efficient. It's to benefit you, not the employee. Because he's not, the employee's probably not going to throw the wife and children in a big dump truck and go over to the Sonic for dinner. Okay, so it's a benefit to you that he takes his dump truck home and then goes right to the job. Okay. Huh?
You don't know Rutherford County well.
Todd says I don't know Rutherford County well. Well, now that you say that, I think I've seen one at the Sonic. Okay, bad example. If it's for the benefit, let me back up. If you give that employee a vehicle and off time, he can do whatever he wants with it. But during work hours, he's expected to drive. If he can do that, the time he's using it, he or she, they, are using it for personal use is a taxable benefit to the employee. Okay, let me say that again, because this is pretty, and these numbers can really add up. Okay, so the IRS counts counts this as a fringe benefit, okay? And it is supposed to be added on to the employee's taxable income, the personal use of a business vehicle. Now you get into a whole question of business versus personal. And like I said earlier, if you're letting the employee drive this vehicle home, another example is, and I've actually had this scenario with several employees, they drive a vehicle that's maintained in a company warehouse. Okay, I got a question. That's good. Let me get into that in a minute. Let me finish this one. So I've had this with several employees. The company has a car lot kind of a thing, a garage where they keep their company vehicles. So the employee shows up to work, 8 o'clock in the morning, they go over there, they get their car, their vehicle, whatever truck, whatever the company gives them. They leave, they go do their job, they come back. Well, this parking garage thing, they lock it up, it closes at 6 o'clock p.m. So if the employees aren't back in time, it's okay with the company, or if, let's say, they're all the way across town. Now, these people are in a bigger market where there's a lot of traffic. They could get held up on Highway 77 over there in Charlotte. They could be in traffic there for an hour and a half. So they may not be back till 7:30. So the company says, in that case, you can just take the vehicle home, go on home, come back in the morning with it. But at no point are they saying it's okay for you to drive around with it. You can go home with it. And that is not personal use. That is not a benefit for the employee. That is not taxable. But if you let them, if part of their job is, I will give you a vehicle, when you're not working for me, you can do whatever you want with that vehicle, that is taxable. Now, how does the IRS track it? And how do you keep records of the difference? And that really gets back to the whole thing of, how do we expense vehicles? How do you do this calculation? You know, there's a complex calculation, which for most small businesses is just not, it won't work, is what if you were leasing that vehicle to the employee? What if you were leasing the vehicle? What would the value of the lease be? So you've got the leased vehicle auto lease valuation rule, which just involves a lot of math. You've got another rule, which is the actual wear and tear, maintenance, expense of that vehicle, and fuel. Or the third method, which is probably the easiest and the best, is the mileage rule. How many miles did the employee drive that vehicle? And the employee is expected to keep records. The company is expected to keep records. And the company is expected to report that as a benefit, taxable benefit to the employee. Now that's what the law says. The reality of it is most people don't do this. Most companies don't do this. They just write it off as a business expense, and the employee never writes off the personal use of it. But just know, if you have a lot of vehicles and you get in an audit situation, the topic may come up. The auditor may ask you, so these employees drive these vehicles home. What happens when they go home? And what happens on the weekends? And what if the employee wants to go out of town? They want to go down to the beach on Friday. They want to go down to Charleston on Friday and come back Sunday night. And they take that vehicle. Are you okay with that? Oh, yeah, we're fine with that. They can do that. You've now just created a taxable event for that employee. So just be aware that is the law. And there's a lot of scenarios that I can get into on that. It's already time for another break. So if you have any questions on this, please feel free to call me. My telephone number is 828-289-9300. Now, I've gotten a text already because somebody who knew that I was going to talk about this. I'm going to go back and talk about the entertainment. I talked about that last week. Entertainment expenses with this new tax reform are gone. I mean, I just hit on that real quick, but I am going to talk about the 10 most common mistakes people make when they open up an IRA. Because this is the time of the year that to save money, people open up IRAs, and I'm going to talk about borrowing against your 401k or IRA as a business startup. It's a little known law. It's a little known thing that's getting more and more traction lately, and this can be a big trap if you do it wrong. You're only going to get this right here at Gilbert Talks Taxes, WCAB 590 AM. We'll be right back.
This is Gilbert. If you owe the IRS past due taxes, don't call those toll-free national numbers. Local, affordable help is right here in Rutherford County. Stop garnishments, levies, and liens. Call Gilbert Carmona at 828-289-9300. All initial consultations are free. Call Gilbert, 828-289-9300.
We are back. WCAB 590 AM, Gilbert Talks Taxes. So the question somebody just called in, how has the new tax law affected business? Well, I pretty much have been talking about that for weeks now. How, if or any changes at all. Section 199, there's a 20% deduction on your income for your business. That's in the new tax law. If you own a business and you're an S corporation or you're a Schedule C filer, and your net income after expenses is below $351,400 or to $451,000 and phases out, you're entitled to a 20% deduction. This is the biggest tax credit for small business I'm ever aware of. This is major. Section 199A. If your accountant or your bookkeeper, whoever, is not talking to you about this, please get another accountant. This is, and the tax planning for it is now. This isn't something that, some things we talk about in November, December. Like, should you buy more equipment? Should you spend more money? Where are we at? How much money did you make? No. This takes tax planning that needs to be done now because you want to be maximizing that deduction. 20% deduction right there, boom. So next, what else? For self-employed people or people that get a Schedule S, now this is on the personal side, but if you're self-employed, it all ends up on your personal tax return. Standard deductions doubled. So where this year it's $12,000, next year it's $24,000. That's also going to be major. And then these depreciation I'm talking about, Section 1031. This has totally been changed. We've got new rates for the Section 179. This tax law touches every part of your business. Again, if you're not talking to somebody about this now, you need to. Every business tax return I do, we discuss old law versus new law. What do we need to get a hold of for next year? I mean, I'm spending hours talking to people about this. It is that major. Is that another one? Another one. Farming in the farm business. It's the business, so these same rules are kicking in for you. I'm not aware of anything specific to farming yet. I've got a lot of farmers as clients. Those of you, I've got poultry producers, I've got livestock, and of course I've got agricultural. I've got several that are doing straight agricultural, tomatoes. I've got a large farmer just working tomatoes. I've got some mixed. And I've got several equestrian that are just doing horse breeding. Now, I'm not anything special for farming, but pretty much all these same rules apply. The Section 199A is regardless of what type of business you're in. Regardless. It's any business. Now, it's favoring some businesses over others. It's high net earning businesses. Doctors, believe it or not, accountants, lawyers, some of the high athletes, some of the higher net earners, they're going to be not getting as much of a deduction on the Section 199. But what I'm seeing across the board, your average businesses, especially your small businesses, are going to benefit from a 20% tax reduction. And then the rates, capital gain rates and the income rates are all lowered. Corporate tax rates been lowered. So you should be seeing lower rates across the board. It just depends what kind of, how you've set up your structure. Is it an S Corp versus a C Corp? You know, your corporate structure and how you're handling a lot of your expenses. Now, again, this Section 1031 can affect you farmers with your equipment purchases. If you're heavy equipment, like several of my people, I had a conversation with a farmer. They invested in a $100,000 piece of equipment. We talked about that, and there were some certification issues with it and some expensing issues. But what I'm seeing is it's going to be good all across the board. I wish I could be a little more specific. I'm going to take the farming question with me. I'm going to research it a little. I'm going to talk a little bit about that next week. This time of the year, well, let me talk about the entertainment expenses that have been wiped out, because I see this on everybody's tax return. Every business, most business tax returns will have some kind of entertainment expenses. Just know that a traditional entertainment has been repealed in this tax law. So business meals with clients. You know, we used to, everybody says, come on, let's go have lunch. We're going to talk about business. It's a write-off. Well, that's over. Okay? And for those of you that take clients out golfing or on ski trips, basketball games, baseball games, soccer games, Disneyland, those kind of things, that's over. Those expenses are not going to be allowed anymore. Now, tax reform did eliminate those. So, I mean, the good side of it is, for those kind of things, you're supposed to have a lot of documentation. And some of you are very good at it. A lot of my clients, I've trained them over the years to bring me in the receipts. They write on the back of the receipt, or they'll attach a piece of paper to it saying who the lunch was with, who was there, you know, what they talked about, what it was for the purpose of the lunch. You just can't turn in a receipt and say it was a business lunch. Really, it was a business lunch with who? So, I mean, for it to be a business lunch, you had to have a client or a potential client. This is really going to hit like real estate people who do a lot of business at the lunch table. I mean, you go into any restaurant at lunchtime and you're going to see some real estate agent talking to a client. It's just what they do. Those kind of people, salespeople, this is really going to affect them because they're the ones that do the dining expense. But just, you need to know it's gone, because for a lot of people, this is a big expense. I have a client that is their business. Their business is taking people out, entertaining them, spending time with them, and presenting their business concept and getting them to invest in the business concept. And that is how they make their money. Everybody that invests in this business concept, and I'm trying to be very deliberately vague of how I say it all, because I don't want to give the business away. I don't want to give them a plug. It's what they do. Their entertainment expenses are 30% of their income. It's all legitimate. They've actually been audited, and the auditor said everything's fine. We had all the documentation. We had binders of documentation, and the auditor was fine with everything. This is gone. So that is 30% of expenses for this business is gone. You can see how major that is. Okay, I'm going to move on from that. I'm moving quickly here, Todd. I am moving quickly. Some entertainment expenses still do exist, though. They didn't all go away. Ones that are of benefit for your employees, meals and things you pay for your employees, and there are some strategies you can still apply. So don't say it's all gone. You need to talk to your tax advisor, your financial planner, whoever helps you with this. And again, if your financial person's not talking to you about it, they're not up on this law. So this is the time of the year that people come to me and want to invest in an IRA because there's a tax deduction with an IRA. Okay? If you put money in an IRA, that amount is deductible from your income. It's on the first page of the tax return. We call it the lower part. There's the upper part and the lower parts. On the lower part, your deductions to your income. So you have the amount. There are 10 mistakes. Actually, one of my vendors compiled this great list, and it's everything I've seen. There are 10 common mistakes that people make if they're considering investing in an IRA. or even if they have an IRA. There are 10 mistakes I'm going to hit on. Now, if you're over 50, you can contribute up to $6,500 because of the catch-up rule. Lets you do an additional $1,000. If you're below 50, it's $5,500. If you're above 50, it's $6,500. So you need to start thinking about this now, because I have a lot of people come end of March and they have a tax bill and they say, what can I do to reduce this tax bill? Well, do you have money to invest in an IRA? Do you have any money? Well, I got a couple of thousand. Well, you can invest up to $5,500. Well, I wish I'd known. I would have saved a little. So that's why I'm talking about it now, because I hear that a lot. Now's the time to start planning for it. You can invest in an IRA until April 17th. This year, that's the filing date, April 17th. April 15th falls on a Sunday. April 16th is a federal holiday. So April 17th is the last day to file. It's also the last day to fund your IRA. So you've got a couple of months here to plan this. And this is very important planning. But let me tell you what the 10 common mistakes are. Number one is making a mistake in a rollover if you're going to roll over. So if you've lost your job for whatever reason, you quit, you left, and you have a 401k or an IRA somewhere, yes, I just got a question. Is that for last year? I'm sorry, I stopped to read the question. Yes. This is live radio, Todd. This is where we're moving here. That is for last year, for 2017. So the tax return we're doing now is 2017. You can invest in your IRA now and get credit for last year. Okay, till April 17th. This is the last thing you can do to reduce your tax bill for 2017. December 31st, close the curtain on 2017. There's nothing else you can do now. You can't buy a piece of equipment. You can't do anything to reduce your expense for 2017. Okay? So, but you can invest in an IRA. Now, people make a rollover mistake. That's number one, rollover mistakes. That is, a rollover mistake is when you roll the money over from one account to another. Some people will actually take the money. So you've got 60, you can take the money and you have 60 days to put the money back in. Well, a lot can happen in 60 days. I never recommend doing that. If you're going to do a rollover, just roll it over. Do trustee to trustee, which is called a direct rollover. Direct rollover, trustee to trustee. If you take the money and that money touches your hand and it goes in your bank account, you have 60 days to put that money back in an IRA. Okay? If you don't put that money back in an IRA, it becomes a taxable event. Now, when you get that money, some places will tax it. That 20%. Unless you have that 20% laying around, they might do 15%, 15 or 20%, unless you have that laying around, because you're supposed to roll back over the full amount you took out before taxes. So if you took out $10,000, but you only got $8,000 because they took $2,000, you have to get $10,000 back in that IRA. I've seen people get burned by this. Then they come and do their tax return, and I say, well, you owe $400 on that $2,000. What? That got taken out, that 20%, because that's now taxable. But that is the tax. No, they took that out. You got that. So I know it's complicated, but rollover mistakes. If you're going to roll over, please talk to your advisor. Excuse me. The second big mistake people make is they don't consider a Roth IRA. I'm not going to get into all details about a Roth, but just consider a Roth IRA. It may help you in the bigger tax picture. Okay. The third one is forgetting catch-up contributions. People forget they turn 50. I turned 50 last year because it's your age last year, not this year. I turned 50. They forget you can do another $1,000. And the other thing another $1,000, yes. And the other thing you can do is, just because you have a 401k or a SEP or some plan where you work, it doesn't mean you maxed out your contribution limit. I often see people who contribute to a 401k or a 403b, and then when I crunch the numbers, I see that they could still they can still contribute another $1,000, $500, $2,000, and get a tax deduction for doing that, and you're saving money. So don't assume that you've maxed out your contribution at work or whatever plan you're in. Fourth mistake, beneficiaries. People forget to name a beneficiary. When I set up an IRA for people, I don't let them do that. You're going to name a beneficiary now. I'm not submitting the paperwork without a beneficiary. Why? Because should something happen, that money, see, if you pass away, that money goes directly to that beneficiary. It doesn't go through all the probate and all the court stuff that the rest of your estate's going to go through. And if you set up an estate like a trust or something, it now goes to that estate. It could be a taxation nightmare without a beneficiary. Plus, if you want a beneficiary, let's go ahead and pick it now. But people say, I'll name one later. And what happens to later? They never get around to later. The fifth mistake, and I've seen this one twice, but I've heard 100 stories about this. They have an outdated beneficiary. I think anybody who's been in financial planning as long as I have is going to hear many stories about the man that died. His wife calls up the brokerage company and says, my husband has a 401k. My husband passed away. How do I get the money? And the person says, what's your name? She says the name. He says, you're not the beneficiary. The beneficiary is so-and-so. And the lady says, well, that's his ex-wife. They've been divorced for 20 years. Folks, this happens a lot. They've been divorced for 20 years. That's my money in that 401. We've been married for 20 years. No, ma'am, it's not your money. The beneficiary is this lady. And what are the odds of an ex-wife saying, oh, go ahead, you can have that $300,000? I'll just stop there. The sixth mistake, people will name a trust or an estate as a beneficiary. Could have bad tax consequences. Really consider that. It's best to name a person. For most people, I don't want to make a blanket statement. For most people, just know if you're going to name a trust, it needs to be a look-through trust. There could be Roth conversions. All kinds of things could happen there. Just know naming a trust as a beneficiary has issues. It could be a mistake. And what I mean by mistake is it might not give you the consequence, might not give you the result you want. It could have a bad consequence. I'm trying to move through this quickly. It's already time for a break. Not knowing that you've got distribution options with inherited IRAs. People make a lot of mistakes with that. And then just overlooking tax deductions of inherited IRAs. There's something called IRDs. I'm not going to get into that. There's deductions there. Now, the biggest mistake that I personally see, the next two are the biggest mistakes that I personally see a lot of, is not cleaning out old accounts. People will have, because you may have 2 or 3 jobs, and every job had a 401k. I'm working with a lady right now who, she's in the medical field, worked at several large hospitals, has multiple 401k accounts. We are going through a time putting those all in one account. One hospital didn't even have any records of it. It's not even the company they're dealing with now. This was like 15 years ago. We've had to go find old people and find out who to even call to get this money. The last and biggest mistake, trying to do this yourself. Folks, don't try to do this yourself. If you're considering a retirement plan, please talk to a professional. I want you to talk to me. That's why I'm here on the radio. But if you don't talk to me, talk to somebody. Somebody that knows what they're doing. And you know what I tell people? Talk to 2 or 3 people. Even if you talk to me, go talk to a few more. Licensed people who know what they're doing. Let's take our last break. This is Gilbert Talks Taxes, WCAB 590 AM.
I want to welcome Tim Schlabach and Foothills Photo Works, a professional hybrid commercial photography studio. If you're concerned about your social media image, listen up. Whether you're an executive, real estate broker, lawyer, or business owner, your image matters now more than ever. And you know first impressions count. Whether you need professional portraits, corporate headshots, images of your products or facility, aerial photography and videos of buildings, boats, or large acreage, affordable professional help is here for you. Foothills PhotoWorks can create media that will help your prospects get to know you better and help you look your best. Call for an appointment. That number is 828-668-2304. Mention this ad and receive 15% off your first session. That's 828-668-2304. Foothills PhotoWorks, your media professionals.
It's official. I'm celebrating another year of looking fabulous, all because of RSL Salon. Whether it's a hairstyle, a manicure, or a pedicure, call Robin at 289-9110 because everyone deserves to look fabulous. That's 289-9110.
Gilbert Talks Taxes, WCAB 590 AM, the most researched tax program on the radio in America. I'm going with that. I'm really going with that. But I moved through that. That was a 30-minute program right there. That was 30 minutes of a program right there. The 10 most common mistakes people make in IRAs. And I see them. And once you make this mistake, it's not like you don't get a do-over. You can't call the IRS and say, oh, I didn't mean to do that. You know, because once you die, that's it. You can't, and the beneficiaries are stuck with these decisions. That's why it's just so important. I can't drive that home enough. A good tax plan takes time to develop and time to discuss. Now, I'm going to talk about something, and I'm a little leery of really getting into this because this is very complicated. There is something, it's actually been around for about 35 years. Most people don't even know this exists. Most people in the preparer community have never heard of this. I know financial analysts that don't, I mean, they're aware of it. I've been reading a lot of blogs. I've been researching this heavily. I spent about 3 hours the other day just researching this. And that's 3 hours prime time of the middle of my day working on this. I actually talked on the phone with the man who gets the credit by the IRS, not from anybody else. He gets the credit for developing this. When the IRS wanted to reevaluate and they had questions about what's going on with this, this is the man they called. I talked to him on the phone. Now, it was just a casual conversation. I didn't record him. I'd like to, though. He's a nationally known speaker on the subject. He gives workshops, seminars. He has probably every letter in the alphabet after his name in some kind of abbreviation. He's an incredibly interesting man. And to be able to talk to him on the phone was major. There is something called a rollover as a business startup. Rollover as a business startup. They call it ROBS, R-O-B-S. The concept is that you can take money from your 401k or your IRA. Now, it has to be more than $50,000. You can take money out and use it to buy or start up a business without a tax implication. Okay? Now, let me start by saying this. For most people, this is a bad idea. Okay, I'm going to let that sink in. For most people, this is a bad idea. Because this is your retirement nest egg. Is your 401k is what you're going to go into retirement with. But this does exist. It is out there. You know, we've always been told the only things you can pull money for out of your IRA or your 401k is you can pull out, $10,000 for the purchase of a home without paying the penalty. You still pay the tax. So if you're younger than 59 and a half, and this has really been an inducement to get younger people to start funding in a 401k or start funding in an IRA, is they say, well, I'm 30 years old. You're asking me to tie this money up for 30 years till I'm 59 and a half. Well, what's a 30-year-old? What are some of the things a 30-year-old might need money for? Well, buying a house. So married couple can each pull out $10,000 from their IRA without paying the penalty, which is 10%. You still have to pay the tax. at whatever your tax rate is, but you won't pay the penalty. The other thing is for medical, and it's got to be major medical. It's not, you didn't feel well, and so give me $10,000. No, it's got to be for medical, and it's limited by the medical bills. So you have to document that and have medical bills to back that up. You won't pay the penalty. You'll still pay the tax. Higher education for you or a child, you can pull money out. But you can also pull money out to start up a business. There are a lot of rules with this. A lot of rules. You must start a C corporation. It has to be a C corp. It cannot be, you cannot be a Schedule C filer. You cannot be a S filer. It cannot be an S corp. It cannot be an LLC. It cannot be a partnership. It must be a C corp. So you must start a corporation. And what actually happens is the money gets transferred from your 401k or your IRA into that corporation. And then what that corporation does is it goes and either buys a business, and in the case of a corporation buying another corporation, what a corporation would actually do is buy the controlling stock in that corporation. So a person has a corporation with 10,000 shares and they need a cash injection, whatever. They're willing to give up control of the company. They're willing to give up stock. So you can buy stock in that corporation. Now, if, you can be active in it. You can buy the company flat out. You can start up a company. You can buy a franchise. You're not limited to what you can buy. There is no limit. But there's a lot of things to consider before you do this. Number one, you must work with somebody. You must work with a CPA, an enrolled agent, which is what I am, a tax attorney, a plan specialist of some kind that knows what they're doing. There's a lot of documentation in this. You must file a Form 5500, which is a form that gets filed when you have a 401k. That form gets filed for you. You don't even know. It's behind the scenes. But now that you're assuming this 401k, you're responsible for that filing. And what that filing is, it's telling the IRS where you're at and how much money's left. Where I have a problem with these rollovers as a business startup is we know the failure rate for small business is, depending on the business, it's 80%. Restaurants, it's 90-something percent. And people that might decide they want to start a business may look to this money. You really need to sit down and talk to somebody about this before you do it. If you do it, you really need to be working closely with somebody on the bookkeeping, the payroll. You've got to account for everything. Now, the people I'm working with on this now, the goal is to sell this business, hopefully for a profit, and the profit goes back into the 401k to make it whole where it was before, and they get to keep the gain. Now, there is a way to structure the sell-off so that it is not a taxable event. Let me repeat that. There is a way to structure it, but it's got to be structured correctly. I'm speaking very slow and very deliberate here for a reason. There is a lot to this. If this is something where, are you holding the 1 minute finger up? We got 1 minute?
10 seconds.
If you're considering this a rollover as a business startup, please give me a call. My telephone number is 828-289-9300. We're done for today. It was a fact-filled show. I put a lot of information out there. Again, if you need me, my telephone number is 828-289-9300. I will be back next Saturday from 8 to 9.